Okay. What's going on, everyone? Welcome back to another morning live stream here on the Predicting Alpha YouTube channel. So guys, if you're new to the stream, just to let you know, what we're basically doing here is a 30-minute live show every morning where we take a look at the numbers behind different stocks that are popular. We take a look at the data, try to find the best way to structure out a trade for the different views that people have, right? When we're bullish on a stock, what's the best way to take advantage of it? We're looking at the pricing of the volatility, trying to figure out where's the market giving us some opportunity and where can we maybe, extract some value where someone's willing to overpay for something or where we can find some cheap options to buy. And that's really the game plan with this show. Give you a half-hour session, give you some stuff to think about, a couple trade ideas so you can get on with your day and have a few plays if you're looking to take some trades. Because it's earnings season, a lot of what we're focusing on is going to be earnings related. Here's the thing, guys. I need to ask you a question right now. Are you able to see my whole screen and me in the corner? Because when I go over here to the live stream tab, it doesn't show me that. It says like that you guys can sort of see this corner in the top left, and that's it. What are you guys able to see? You're able to see everything? You can see me if I wave? Okay, perfect. Yeah, I don't know what's going on. Like if you look up here, it's showing me a pretty messed up view and it was throwing me off. But I'm glad to see that you can see everything. Yeah, Tim, we're always leveling up here at the Predicting Alpha, headquarters. So we got a new fancy banner at the bottom. Little spot to write some messages if I have any special announcements. So, Ernie says you want a sticker. Like what? Well, you want a Predicting Alpha logo to slap on your laptop? We can hook that up. I can make that happen. So guys, this morning's stream, we are going to be focusing on earnings. We have a really big earnings day today. We have, Ford, Peloton, Pinterest, Snapchat, just a whole bunch of stocks that are totally worth looking at. A lot of these are going to have really high implied moves. And that is really one of the key factors that we look for when we're looking to sell volatility around earnings. Now, this earnings season so far, it's not been a stellar one from a liquidity providing perspective, from the perspective of selling options around these events. It's not been amazing, couple blowouts here and there. But the beauty of earnings trading is that each of these events are uncorrelated. Meaning just because the last one had a big move, it doesn't mean the next one is going to. And because we have so many events and we have a little advantage from a data perspective going into each of them, as long as we play each event with a small, risk on the table and we play a lot of these events, we should be able to come out winners in most earnings seasons. So we actually took the liberty of back testing our earnings strategy over the last 20 seasons. And of those, we only had, I believe it was one season that was actually unprofitable, taking all the good plays, more or less. If you just spread your risk across all the ones that were like, you should sell, you came out profitable almost all the time. Now, how profitable, obviously, that varied. Sometimes you'd be a little bit above break even. Sometimes you'd make 30% in a season, 40% in a season. So pretty cool stuff. Pretty cool stuff. But today, we're going to be spending all of our time in this earnings analyzer tab here, right? Really taking a look at what some of the data looks like behind trades that everyone here is probably looking at, right? Snapchat earnings, Peloton earnings, Pinterest earnings. These are things that have been on everyone's radar. But the question that everyone asks around earnings is, what do I actually do about it? And we're going to take it from a little bit of a different perspective, right? If you've been tuning into the show, you know what I'm talking about. But if you're new to the show, might come as a little bit, might seem a little bit foreign to you, and that's okay, right? Really, what we're trying to do here is even the playing field between what us, the small guy, the retail trader has, and what the professional traders have. And to give you an idea of why we're doing this, we've been trading for a long time, and there's sort of like a stigma around the word retail trader, right? Retail traders are sort of, it sort of gets laughed at a little bit in the financial world. And I really thought about why that was, right? Is it because, it's like the big rich investment banker and then like, you know, the little guy, right? And they're like, he's, you know, so much less capital than me, you know, and laugh at him. It's actually not that. It has nothing to do with the size of the portfolio. It's actually because retail traders are notorious for making bad decisions, right? That's what trading is. Trading is a game of decision making. And, you know, the retail trader just, you know, he's got the brunt of the decision making. He's not necessarily been known for making the best. But the thing is this, it's hard to make good decisions when you don't have all the information, right? And if you think about what's happened on Wall Street in the last 20, 30 years, most people don't even know what a Bloomberg terminal is used for. They don't realize that behind that $25,000, $50,000 paywall is trillions of data points. Trillions of data points. And the tools to make sense of it, find relationships in it, find inefficiencies in it, and do something about it. And that's what we're competing against. But there's this huge divide. So all we're looking to do, the reason why we do this stream is we are looking to democratize financial data, right? Make the type of information that has given Wall Street an edge, the real edge that Wall Street has over us for decades is not that they work harder. It's that they actually have information that we most likely don't even know exists. Right? And that's what we're trying to showcase here with the Predicting Alpha terminal, right? Give access to that as something that can actually be afforded. So let's hop into it and take a look at what I'm talking about, right? Well, I'll show you how I break down an earnings event. Let's take a look at, you know, Peloton's not looking, you know, maybe we'll start with something a little different. Let's maybe start with, let's take a look at Snap. What's going on here? When Snap earnings? Just to make sure that it's scheduled for the right day here. We're cleaning up our earnings date numbers, so I always got to double check it here. Snap earnings is tonight, right? Okay, yeah, it is tonight after the close. Perfect. So Snap earnings, we can see that implied move is about 13%. Average move is 18%, right? So what are we talking about here? Well, you can think of it like this. Implied move, right? So we have, you know, there's different types of volatility, right? So options are volatility products. And I'm going to open up my whiteboard here to break it down for you guys. So there are three types of volatility that impact a stock, right? The first is market volatility, right? So if you're a stock, right, let's say this is Apple, you know, and this is Microsoft. Well, you know, Apple could be going up, Microsoft could be going down. But if all of a sudden the market goes down, Apple will go down and Microsoft will go down. Each of these stocks is impacted by what happens to the overall market, right? It's sort of like the tide raises all ships and lowers all ships, you know? So that's the first kind of volatility. And, you know, it'll make sense why I'm pointing that out in a second. Now, any company, let's say we're looking at Apple in particular, they have their own form of volatility, which is their non-event vol. Right? And think about this, right? Apple is a good company. You know, it's been outperforming the S&P. They make good products. Their revenues have been increasing. So on an average day, you know, it maybe moves 1 or 2% up or down, trends upwards. That's just their regular volatility, the magnitude with which this stock moves. You know, a penny stock, for example, has tons more non-event volatility. It moves 20% a day. But then there's one more form of volatility that impacts each of the stocks, and that is event volatility. And this is volatility driven by one-off events such as, you know, earnings or product releases or battery day, right? This is this event volatility. And what we're doing in the earnings tab here is we're asking ourselves, what is the market implying the event volatility to be for a given company, right? Earnings are an event, and we can actually go into the option chain, right? Take this in. When you have the background to be able to do it, you can go into the option chain and extract the market implied move for earnings. What the market is actually saying is going to happen around an earnings event. And that number is right here for any stock that we look up, right? We're going to look at Ford later today. I type in F, and here's the implied move for Ford. Let's go back to Snap now. Now, so what we can see here for Snap is the implied move is 13%. And the average move, right? So that's what the market's saying is going to happen tonight on earnings. Well, what happens on average around earnings? We can see that on average, Snapchat actually moves 18.5% on earnings, a lot higher than what the market's implying this time, right? So that's something that we find pretty damn interesting. And another question we could ask ourselves is, well, what does the market usually say is going to happen? Is the market usually overstating or understating how much the stock is going to move? And we can see here that on average, the market says it'll move around 13%. So market's implying the same as what it usually does, and it's been systematically less than what we see on average. Now, here's the one thing, right? Off the bat, that means I start to think to myself, maybe these options are cheap going into earnings, right? Maybe these options are cheap. But we need to ask ourselves one more question, right? Like, what is the odds that this, like a company, when it moves like crazy on earnings, it means that someone's getting something wrong here, right? Maybe the analysts don't know what actually drives the value behind Snapchat. You know, maybe it's not revenue, but it's user base, or it's net new users, or it's net new ad sponsors. What actually drives the value around Snapchat? Someone's getting something wrong here. A stock should not be moving 13% 18% on average around earnings, right? Earnings should move that much when there's a surprise. And clearly something's been surprising here. But the question I would ask myself before I buy options right now is, well, what would be the surprise this time? Right? Just because the average move is so much higher, it doesn't mean that it will be this time, right? Because what we're not talking about, implied move of 2, average move of 4 or 5, right? What we're really saying here is implied move huge, average move bigger than that. And it's like, whoa, how sustainable is this? So, because I'll give you an example. One of the factors that I look at, right, one of the most important factors when trading earnings is not just implied versus average. It's actually the level of implied move as well, right? If an implied move is 2% and an average move is 1%, well, the implied move is technically 2 times as big as the average move. It looks like the market's always overstating it, but because the move is so low, it doesn't actually make sense to be selling it, because your risk is that if there's a blowout, right? Let's say it moves 10%, well, you're done, right? You're going to lose a ton of money. Whereas if you're right, you're going to make, a couple points on vol. Like, it's not, right? It's not really juicy. Whereas with this, right? Let's say, implied move of 13, let's say we sell an implied move of 13 and it moves 18, we're not going to lose as much as if it moves maybe 2%. Right? So let's go take a look at that. We'll actually, I'll go into Thinkorswim now and I'll price out a straddle on Snapchat and we can talk about this, right? And maybe we'll even do an iron condor, to put some of that protection in place. So let's go to Snap, pull up the option chain. Now, since, coming back to my whiteboard here, since we are trying to isolate that event volatility, right? If we drew out a timeline here, and we'll say this is a market close on day 1 and this is market open on day 2. The event happens somewhere in here. And since we want to isolate the earnings event, I'm going to enter the trade at market close it sometime at market open, and I'm going to trade the shortest days to expiration, right? I'm going to trade the shortest days to expiration here to maximize my exposure, right? That option's sensitivity to the event. Now, since Snapchat, I'm pretty sure it's a liquid asset, right? It's actually not crazy liquid here. So maybe I'll go. Okay, it's not crazy liquid. So we might run into a bit of trouble on execution here. But for demonstration purposes, we'll do the February 5th here, right? I want to be short vol here, let's say. And the reason why I want to be short vol is even though this average move is a lot higher than the implied move, the level of implied vol is very high, making me think that I can get a better trade-off by being short vol here. So let's go back to Thinkorswim. Here's how I would structure it out, right? Stock's trading at, let's call it $59. Right? We want to do an iron condor. The first thing I'm going to always do, is price out the straddle. You see the straddle's going for about $8. So here's what I'm going to do now. I'm going to come here to the at the money strike, sell iron condor. And I'm going to put my sell strikes at the money. So sell the 59 call and sell the 59 put. And now as for my wings, which are really my protection, I need to, the one thing that you have to remember when trading earnings is you have to embrace some risk, right? You're not going to get paid putting your wings $1 away, right? Look at this. We're collecting a 65-cent credit. This is a waste of everyone's time. What we want to be doing is going, in my opinion, 2 standard deviations away for my protection, right? Embrace a 2 standard deviation move. And quick and dirty way to get a standard deviation, it's not perfect, but is a straddle price, right? So we saw that straddle is $8. So a 2 standard deviation wing would be $16 away. So we're going to come here to this call option. We're going to go 59 plus 16. That's what, 75? If I do my quick maths correct. And then 59 minus 16 would be 43. God, mental math. Mental math in the morning, guys. It's not ideal. So we can see here that this straddle, right, if we get filled at the mid, this iron condor is going to cost us $7.40. Right, we'll analyze that quick. We'll have it here. All right, so we'll have that on. All right, you can see here's our beautiful little iron condor. And let's also see if we just did the straddle, right? How much are we paying for our wings here? You can see the straddle would have cost us $8.17. So we are giving up about 77 cents to buy those wings. It's a good bit of our edge, right? That's a pretty good bit of edge that we're giving up there, right? At this point, if we see, if it moves 8, so, we have pretty good break even here. Pretty good. It's about $7 either way. Maybe 11% move instead of the 13 that we saw here, right? Because this 13% implied move, we only really sell this move if we don't buy wings. So we're maybe selling like an 11% move here. Now let's see what happens in a couple of different situations here. If the stock moved, let's say 18%, what would that look like? Well, if it's $60, a 10% move would be 6. So we're seeing it move about $10, let's say. Right? We're going to see it move $10. And volatility, how much is volatility going to come down? You know how vol gets crushed, right? Well, let's take a look here. We can see the implied move, right? Implied vol in the term structure for the near dated options is 121. Non-event is 61. So we're going to see vol get crushed like crazy here, right? We're going to see vol come down maybe 50, 60 points. So let's drop that. All right, we're gonna stress this for tomorrow. What's it gonna look like in the morning? It'll look like this. So it'll look like this in the morning. You can see it'll realize almost all the P&L right away tomorrow. Vol gets crushed 1 day forward, expires, tomorrow more or less, end of day tomorrow. Right. So if we go forward 1 more day, you see it's basically your max P&L. So you're going to fall somewhere on this blue line more or less. And we can see, let's say the stock so let's say it doesn't move, we're going to make almost $3,000. And if it does move, let's say, 20% even, right? So let's say, a $12 move, we're going to lose about, where would it be? Or let's say a $10 move would be more realistic. If it moved $10, we lose about 2,000, 2,500, right? We're getting about a 1-to-1 risk reward, right? It's not bad. And think about it. This thing would have to move 18% for us to lose, the one. Right? It's a huge move. I feel like it's a lot more likely that it doesn't do that again, right? Because remember, analysts get smarter over time. They learn how to better value a company and determine how earnings will impact it. And the more certain the market becomes about what's going to happen, the less likely to see a surprise or a really big move. So that would be my thought on Snapchat. I would be looking to put on a short vol play. I would probably do the Iron Condor, just because we have had these huge moves, right? Like this, if it moved 36%, it would hurt. It would hurt a lot, right? If it moved like 47%, it's going to smoke us. But if we get an 18% move, a 20% move, it's not going to be the end of the world. So that would be the way that I would play this Snapchat trade. Another stock where we see something similar is Pinterest, and Pinterest is releasing earnings today as well. We can see, a really high implied move, really high average move, implying a lot higher than usual. We've seen these just massive movers, right? And if you think about what's really driving this implied move, similar to Snapchat, it's probably these blowouts in the past, right? You'll sometimes see a stock moves, let's say 4% on average around earnings. And then last earnings, it moved 18%. And then the market will be implying a huge move again for the earnings. Now, something that we need to keep in mind is some stocks, there is a lot of volatility around earnings, and this might be one of them, right? Maybe this is still cheap, right? We only have, 7 events that we're looking at here. It's not much, right? It's not a ton to go with. So I'm a little less confident on Pinterest compared to Snapchat, right? Snapchat, we have more data, but here I would be a little cautious. I'd be a little bit cautious. All of them you should be cautious, but this one in particular, I would advise you to be careful. Maybe there's something else we can do here for Pinterest. A lot of people go into these with directional views, for example. Let's say you think that Pinterest is going to go up on earnings. We can see here that buying calls around earnings has been extremely, extremely profitable. Maybe there's something we can do here because the vol level is just so high, right? So if we come to pins, I'm thinking maybe we could buy like a slightly out of the money digital or something. That could be pretty good. Interesting. These are going for like the same price. Check this out, guys. If Pinterest goes above $77 on earnings, you're going to make 400% return, one trade. And it'll be almost instantaneous, right? Because there's only one data expiration. This would be a good trade if you think that Pinterest is going to go up. Now, you could also do the same thing most likely on the downside. Let's see here. Okay, it's not as juicy, but you could do something like this. If you wanted to bet on it going down, look at this trade, guys. What do you think about this? It's the reverse Iron Condor. You cap your gains, though. It's kind of a weird trade. I don't know, but as long as the thing doesn't not move, you'll make some money. Either way. Check this out for the downside, right? You got $180 risk. Make $300, about a 2-to-1 risk reward, betting on the stock going down. Pretty much if the thing moves down, you're going to make your money here. So these would be the two trades that I'd probably feel most comfortable putting on for Pinterest. The odds of this thing moving, what's it trading at right now? $75. The odds of it moving less than 1%, it's pretty low given the volatility that it's seen over the last, 2 years of earnings. So I would feel pretty confident slapping on one of these trades. What you're really doing here is you don't want to just go out and buy the straddle because it's so expensive. But what you could do is you take advantage of the high level of vol, you buy in at the money or closer to the money option, and then you sell a little bit further out because the vol is so high across the board. It pays for a lot of it, and a tight spread like this might not be a bad idea if you have a directional view on Pinterest earnings. So let's keep on moving here. What else can we look at? Let's take a look at Ford quick. I know a couple of the guys, the PA guys, tune into this stream. Ford's one of the stocks that they're taking a look at. So not seeing a huge edge here right off the bat. 6.58% move. It's higher than what it usually does. There's maybe a little bit of edge here. The thing is, because the implied move is not huge, you have to be really careful with your wings here, how much you're paying for them. So let's go structure out Ford here. Let's take a look. All right, we come here. Let's see. Right. Oh, look how cheap this is, right? Honestly, the thing with Ford, guys, I wouldn't be taking it off the bat. And I guess this is one of the things I should have looked at right away. It's too cheap. Right? It's honestly too cheap. Your commissions, crossing the spread, all that's going to hurt. Right? Look, these things are going for a penny. Oh, that was really out of the money. Let's see here. You're getting 78 cents for the straddle. By the time you pay your commissions, everything like that, you're pretty much you have no edge, right? So I would not be taking this. I would just, it's just not worth it. The money's not there to be putting on this trade. So sorry for you guys that were excited for Ford. It has it's stamped with an X from the PA guys. GoPro. Wow, huge implied move. Right, huge implied move. I'd be selling vol here. Right, I would do some research. I would definitely be selling some vol here. It's never moved this much in the first quarter. Implied move of 17%. I'd maybe do a little bit of research into why it's so high. Is this extremely popular retail stock? Has it been realizing a lot of vol recently? Right, we can see the non-event vol. It's not super low, right? It's a lot lower. There's 90 points of implied vol priced in here. But we are seeing just, vol is high across the board anyways, right? This is a tricky one. Non-event vol we're saying is cheap, but, event vol we're saying is super pricey. So pretty tricky. A call and put PA fly on the Ford move. Let's see. If we go back to Ford here. You could maybe put on a call fly. Honestly, let's see what it looks like. So we're at Ford. Stock's trading at, let's call it 1150. Straddle's going for like $1. All right, let's take a look at this. 11.5, 12.5, 13. Right? What do you think of this? I don't know. This doesn't get my rocks off, man. This wouldn't do it for me, to be honest. I probably would avoid it. I don't think there's enough juice there. I think better opportunities will come, and I'm not one to say like don't force the trade, right? I try to stay away from all the hype guru internet stock trader excuses they give you for why you lost money. But what I will say is there isn't always a trade, right? And we don't need to we don't need to be putting on trades that we don't have a lot of confidence in, right? There'll be better ones, right? When it comes to these skew trades, you don't need to think about it like normal earnings where, we want to spread our risk across a lot. You want to be taking ones that you have some like real confidence in, or you're getting just an absurd risk to reward on, right? I had that fly on BlackBerry, for example. Right? I was getting 25 to 1 risk reward, right? I didn't think BlackBerry was going to rip up, but at that payoff, screw it. I'll take a little gamble. right? But I knew it was a little gamble, and but if there were another stock that I had that view on, that I actually thought was going to go up, I would have probably put on a bit more size. Guys, do you have any questions for me about the earnings that we're taking a look at right now? Anything else that I can help with? Because if not, there's maybe only one or two more stocks that I want to take a look at here. Let's go back to GoPro for a second. GoPro's pretty cheap as well, right? Big implied move, but it's a cheap stock, man. Trying to think here. Would I recommend people to be selling vol here? It's really cheap. It's really, really cheap. Let's go take a look. But it has a big implied move, right? See what the straddle's going for. 271. Wow. Let's see here. Let's sell. Let's see what it would look like if we did an iron condor here. 1050 is my sell strikes. And then I'm going about $5 either way. So that'd be 550 on the low side and 16 on the high side. Oh, 550 here. $16 up here. Collecting $1.43 for it. You're paying a lot for these wings. These are pricey wings. So I would be saying you probably don't want to be getting wings if you're going to do this. The wings are too expensive. It makes your range too small. It pretty much destroys your edge. So if you're going to take GoPro earnings, you kind of have to embrace the risk, right? So what you could do, instead of trading so much, you size down. Now you see your risk is really not that bad, right? If you get a huge move, it's not going to destroy your account. You can embrace that damage. So I would say if you're going to do it, trade it small. It's not a bad idea. There's a huge implied move here. And then the last one that I wanted to personally take a look at today is Peloton. So here we go, Peloton. Quick note, by the way, guys, before we hop into Peloton, sometime in February, I spoke to Jordan. We're going to be doing a free trial for the Predicting Alpha terminal. You're going to get access to the terminal, all the education, one-on-one session with Jordan and I. And we're actually only doing this right now for the people that attend this YouTube live. So if you want to enter for that, all you have to do is send me an email right now. We're just building a list of people that are going to want the free trial. This is, we're only doing maybe 50 spots, and it's exclusive right now to you guys on this live. All you have to do is send me an email saying, I'd like to, be on that list. The way it'll work is I'll send you a link. You sign up, cancel within the first week. You won't get billed. You get full access to everything. And there's going to be a few more updates coming before that launches, which are going to make that week highly impactful. You'll really get to understand what trading looks like when you have all the information at your fingertips, right? How does the way you make decisions change? It's going to be pretty cool. Pretty damn cool. If you're excited by this though, and you don't want to wait for a week free trial, you can always just go to our website and get started right away. But yeah, that's something that we're going to be doing in the near future. So shoot me an email if you want it. But for now, let's hop back into Peloton. I'm not sure if I'm seeing anything here, to be honest. Market seems to have smartened up a little bit, but also we don't have a ton of events. Right? Market's implying an 8% move. Average move of 13. Things seem to have calmed down on the last earnings. Screw it, guys. You already know the answer. Short vol lifestyle. We should be selling vol across the board. Screw these Peloton guys. There's no surprise coming. We'll just sell the vol. No pants. No wings on this, all right? Whole account on the line. Let's do it. By the way, this is not financial advice, guys. This is a purely entertainment show. Please do not construe anything that I say as financial advice. But yeah, honestly, not seeing much here in the ways of an edge. Market's usually overstating the vol, right, compared to what the average move is. but it looks like it's smartened up, right? Markets thinking they can forecast the move here a little bit better. 8% implied. I wish that the implied was lower because, I think that you will see some sort of a move here on Peloton. I think they have a few underestimated revenue streams that are coming in, but it'll be interesting to see how their guidance changes coming out of COVID. What are their plans as we start to wind down on this pandemic, right? How does their plan for the year change? So if you have a view on that, I would maybe, consider buying some vol here even, if you think it's going to be a huge surprise, right? And if the stock is moving like crazy already, let's see. Right, it's up 4%. Wow. So yeah, what I would do is, if the stock's got pretty high vol, I would maybe consider, or pretty high realized, but like the implied is not that high. Maybe buy it. Maybe buy some vol, right? Buy an option going into this. Might not be a bad idea. You can see the surface is really, really high here. There's no real skew to take advantage of, right? Let's say you think Peloton's going to go up. It's a little bit of skew, but nothing really crazy, to be honest. Yeah, I'm seeing that too, Sylvain. Have you gone and priced it out yet? You know what this 132 is going to look like for us? Well, maybe it doesn't make sense to do a 132. Maybe we'll do like a vertical. Let's see though. Let's see what the straddle's going for. Always start with that. $13, eh? Okay. Let's go here. Let's buy an unbalanced fly. Just for simplicity's sake, I'm going to start off going $12. So that would be... Oh, I can't. So let's say we start at 152.5 and we go up. It's only in 250 increments, eh? Okay, let's say we go up 10. So 162.5 and then we go up 5, 167.5. Right? You want that to be balanced. It's not super cheap. You can see 12.50 and then, oh man. Okay. So this first one is actually supposed to be 152.5. Check this out, guys. This is not bad. This is not bad. So then, what have you stumbled upon here? So, let's have a look at expiry here. So always remember this. In the market, you get paid for taking on risk, right? And you want to find overpriced risk premiums and different types of premiums that you can collect. And you want to learn how to identify where it's overpriced. So what we're taking advantage of here is the skew risk premium. What we can see is that when we come back here, if we look at just the 10-day options, we can see that the at-the-money calls are, in implied volatility terms, a little bit cheaper than the out-of-the-money calls for Peloton. So what would it look like if we bought some of these and financed it with some of these and then went way out here, and sure, these are higher in implied vol, but they cost nothing, and hedged with a few of these? Well, what we're taking advantage of here is these expensive Delta 25s. So we come here, and this is what it ends up looking like. All right, check this out. We call it an unbalanced fly. Eric, you can get pretty close to your max profit here, right? In the end of the day, I'm not, unless it's expiring worthless, I'm not holding these things into expiry. I'm not trying to convert it from shares to cash. Like the easiest way to think about it is just like this. Here's the stock world. Here's the option world. I'm looking to stay within this world, right? If I exercise my shares, I go to this world. This is not where I want to be. I want to stay over here, right? So for that reason, I'm buying and selling within the option space. I'm not converting. I'm not, none of that. Sometimes you get early assignment, but you've been on the lives where we've talked about that's actually a good thing because you get to keep all the extrinsic value. So yeah. I think this is pretty juicy, right? If you think that Peloton is going to go up on earnings, you can get a really good risk to reward trade where you risk $1 to potentially make $9 if Peloton goes up to around 162 on earnings, right? So by Friday, by the expiry tomorrow. And looking at the earnings tab here, right? Let's say it moves 8% to the upside, right? That would be like what, $12? It'd put us a little on the high side of our fly, but you would still be making a really, really handsome profit here if you get that rally. Now, the one thing you need to be cautious of here is you are not exposed to unbelievably big moves, right? Part of what we're getting paid for here is a really specific range that we expect the stock to land within. If it went up to 175, guess what? You're losing all your money. So, or all your money you invested, don't worry. You're not going to get they're not going to make you put up more margin for this thing. But something we could do if we maybe wanted that exposure is, we could come out here. Let's see. Which one should we do? 70 cents, 50 cents. All right, maybe this one. All right, we could put on this. You're getting 1 to 4 risk reward on this, but if the stock goes above 163, you're going to print. Right? So there's a couple different ways we can take advantage of the skew risk premium. I personally like this butterfly a lot. I think if you're bullish on Peloton, this is the trade to be taking. I probably, if you're a little less confident but still bullish, structuring out a vertical, maybe not a bad idea. But whatever you do, for the love of God, do not come in here and buy this. All right? Don't do this. Don't be this guy. Don't come buy the call. These calls are expensive. I wouldn't be doing this. You're going to have a bad day if you do. Or maybe a good day, but you could have a better day by defining your view and understanding how to take advantage of the options to best express your view in the market. So with that being said, everyone, that is going to conclude the stream this morning. I want to thank you all for tuning in. And remember, if you want a free trial of the Predicting Alpha Terminal, if you really want to see what life can look like when you have access to the same information, MRRT. There are so many similarities between sports betting and option markets. And actually, it's not between option markets, it's between trading. Trading and sports betting have so many overlaps. Like it's actually insane. Look up the sports betting Aaron Brown. Aaron Brown was a risk manager at AQR, probably one of the best option traders of all time. Professional gambler. You should look it up. He built out a model for sports betting, very similar to the way we look at earnings. And it'll really get you thinking, man. It'll get you thinking. It'll get you really excited for that free trial. So yeah, guys, with that being said, all I actually want from you for running this stream is a little like on this video and maybe a little subscribe if you're new to the channel. So thanks a lot, guys. I hope you enjoyed it, and we will catch you on tomorrow's stream. See you around.